Yeah, welcome back. We're here for the second panel, and we will try to be as entertaining as Mr. Schäuble was, but it's always a little bit difficult to make it. This panel is titled "A Fatal Attraction: The Bank's Sovereign Nexus, Banks Feeding the States," an issue that came very much to our mind in the Euro debt crisis. Again, be happy to have a distinguished panel. We have Markus Brunnermeier, who, when I was preparing this conference, learned that he was expected or has expected to follow his father into the business of carpentry before a housing slump defeated his plans. I'm sure we are all lucky because he has done tremendous work on the financial markets and financial crisis, and at the moment he is professor at the Princeton University. Then next to me we have Martin Hellwig, without any doubt one of the most influential economists in Germany, and author of the famous book The Banker's New Clothes. Since 2004 he is director of the Planck Institute for Research on Collective Goods, and especially interesting for us also, among other activities, he's vice chair of the Advisory Scientific Committee of the European Systemic Risk Board. And last but not least, Stefan Ingves. He has two very challenging jobs at the moment. On the one hand, he is governor of the Riksbank, the Swedish central bank, and as many other central banks, the Riksbank has entered uncharted territory due to the low inflation environment. But on the other hand, he's also chairman of the Basel Committee for Banking Supervision. I'd like to start with you, Markus. You have called the interdependence between governments and states in the past a diabolic loop. What does it make so diabolic?
Yes, so I have prepared some few slides. Perhaps I can walk through it. So what I wanted to do here is illustrate this diabolic loop. Some people call it also the doom loop. And I want to put it in perspective to other terms like financial repression, financial dominance, the liquidity risk nexus, and also how it links to safe assets and how it then leads to flight to safety. And this flight to safety can also be across borders, and what are the implications for this. So all of these different concepts which are floating out there, and I thought I would give a little bit of structure how these different concepts are connected to each other. So let's just look at this diabolic loop, and when you look at a bank's balance sheet, you see it directly. I modified the bank's balance sheet a little bit. So you have on the asset side, you have mortgages, loans, and grants. Every bank is granting to its customers. And of course, when you get a mortgage, you immediately get it deposited in your checking account. So essentially, as you create a mortgage, you also create deposits. And if you have to have some safety cushion, like an equity cushion, you have to park your equity somewhere. And typically, you have to park it in a safe asset. And the safe asset is typically viewed as the government's sovereign debt. And that's where, on the asset side, the government shows up. And on the liability side, the government shows up because essentially big banks enjoy some guarantee. I drew it like this. It's not clear whether it's junior to equity or it's actually side-on-side to equity. So it's a little bit like this L-shaped here. And that's essentially how banks' balance sheet in a very stylized way look like. Then I look at the sovereign risk. So if you look at the sovereign, it has the present value of the taxes. On the other side, it has the present value of all the expenditures. And it extends, of course, these guarantees, which are contingent expenditures. Whenever the crisis comes, these guarantees have to be paid out. And when the sovereign risk increases, then the sovereign debt will lose on value, and that hits immediately the bank's assets side. And with it, it also hits the bank's equity. And if there is not enough equity, the guarantees have to be kicked in. And that's where the loop comes in. So that's the first loop, but that's a direct loop which works directly from the value of the sovereign debt and then also through the guarantees sovereign is extending to the banking sector. There are many other loops along this line. So there's an indirect one, which of course what happens in times of crisis is that banks are cutting back on the mortgages, the loans are granting to firms and to households. And that means that the GDP growth is going down. With the GDP growth going down, the tax revenue for the government is going down as well, which again makes the sovereign debt more risky, which hits the banks on the asset side as well. So that's another indirect diabolic loop. And as Andre pointed out in the morning lecture, it doesn't really matter where the initial problem started out with, whether the initial problem started out in the banking sector because banks had subprime mortgages or other positions and lost money on this. like in Ireland or in Spain, or it was starting in the sovereign arena, like in Portugal, Greece, and Andre mentioned in the morning, Argentina. So that doesn't really make any difference. This loop is just feeding on itself and amplifies the whole situation. So here you can also see it on CDS spreads. That's taken from the height of the crisis, how CDS spreads on the sovereign, on the x-axis relative to CDS spread on the banking for different countries. You see there's directly a connection between the two. So what the implications of this diabolic loop is that you typically have a twin crisis. You have a high correlation between government problems and banking problems. And if the crisis can't be avoided, then it will be much worse. There will be a non-linear reaction. So instead of having this linear relationship, fundamental risk is going up, prices are going down. Initially, the government is helping out, but then you have a much more sharper drop-off, like a dropping off a cliff. These non-linear effects are kicking in. Now the question comes here that the government is insuring the banking sector, and the banking sector essentially is insuring the government to some extent. Where's the risk-bearing capacity in the economy? And there are two risk-bearing capacities. On the banking side, it's the equity, which is in the banking system. And what in the government, it's a fiscal space. So how much can the government raise the tax revenue without choking off the economy? Where in the Laffer curve, where are you? And to what extent can the government fund itself? And that depends what's the reputation of the government, what's the commitment power the government has to keep its house in order down the road. It might have a difficult time the next 2 years, but if the government has a good reputation that it can do this and overcome this temporary problems, it can easily overcome this problem. So that's essentially the risk-bearing capacity on the banks and on the government. So ex ante, what's the intention of the bankers? The intention of the bankers is equity is expensive, and why don't you get a free government guarantee? It doesn't cost so much. And that's the financial dominance argument, that you always want to say as a banker essentially be weak, because then in times of crisis, losses cannot pushed onto your balance sheet. They will be rather removed from your balance sheet and be overtaken by the government. So that's the financial dominance. On the other hand, the government's intention is more to push safe assets onto the banks. By safe assets, I mean not necessarily safe, I mean government assets, in order to secure cheap government funding. That's the financial repression argument. That's where financial repression comes in. And there's this tension between financial dominance pushed by the banks and financial repression pushed by the governments trying to get cheap funding. And that's actually, when we talked in the morning, one argument is how to get out of this high public debt level, is that the way we got out in the UK after the Second World War and also in the US, essentially is to have some form of financial repression, where you just shove certain stuff onto the bank's balance sheet and pay low interest rate. So that's essentially who insures whom in terms of credit risk. But equally interesting is who insures whom in terms of liquidity risk. So when there's some temporary liquidity shortage, who is actually jumping it because of some maturity mismatch or liquidity mismatch, very short-term funding for long-term assets. So in terms of the liquidity risk, it's a similar question, why should the government actually issue long-term bonds? And one view is that the government is, if it were to issue short-term bond, it's subject to rollover risk. So it issues long-term bonds in order to buy insurance against this rollover risk or liquidity risk from the banking sector. And in return, the banking sector gets essentially a term spread. Okay. And that's a standard arrangement that one can have. In this case, the banks are insuring the government. But the problem is, if the banking sector is not well capitalized, you're essentially buying an insurance from somebody who cannot provide the insurance. You just hand over some gift to the banking sector. There's an empty insurance essentially going on. So that's in one sense. So if the banks are well capitalized, you can see this insurance. But the question is, why should a government buy liquidity insurance, which can be much more cheaply provided by the central bank if you control your own currency? The other angle, you could say, oh, the government, here I mean the central bank is insuring the banks. And the way you can see it this way is that essentially the government is actually redistributing wealth towards the banking sector in times of crisis, or more generally towards the sector which is financially impaired. And one way to do this is by cutting the interest rates or doing some other measures. What you do is you cut the interest rate and then you increase in the relative prices the value of the long-term bond. So by changing relative asset prices, you shift wealth around, there are wealth effects, which then benefit the impaired sector. And this way, the government essentially provides some insurance for the banking sector. And that's the role of the long-term bond. It allows you, gives you another asset where you can shift wealth around. And that's why I would like to have some liquid long-term bond floating around. And for this actually to work and function well, what you need is you need some liquid long-term bond market. So it can't be that it's a highly illiquid bond market held primarily by some foreigners. The final thing I would like to mention are the cross-border implications, I think, which are very interesting as well. What happened during the crisis in Europe, that all the debt holding became much more nationalized. By nationalized, I mean within the country. Foreign investors withdrew as the crisis became more severe. And one reason for this, one rationale, it's much more difficult for a government to default on its sovereign debt if it's held by its own banks. If it's held by foreigners, it's much more easy. So that's nationally, the willingness to pay for these bonds is higher for domestic banks than for foreign banks, because foreign banks you will default on much more easily. That leads naturally to some buying and selling of this sovereign debt. The interesting thing is what happens if a country doesn't have a safe asset, doesn't have a sovereign, so it has a sovereign debt, but it's not safe anymore because it's subject to default and the diabolic loop is kicking in. Then the bank essentially has two options: to buy foreign safe assets, so sell your own domestic sovereign debt and buy foreign safe assets, let's say the German Bund. And this leads to large cross-border flows. That's what we saw in the crisis. Whenever the crisis became more severe, funds were flowing out of the peripheral countries into the core. When the crisis receded, it came back and flew in the other direction. Or the banks have the option to bet on their own sovereign debt. Okay, you just say, when the country defaults, I will be gone anyway as a bank, so I'm just betting full force onto my own sovereign debt. And I think both are distortionary, and there needs to be some problem to be solved. And I think Martin will probably talk more about what the ESRB is envisioning on this dimension. One solution is to have, instead of having this national safe assets where suddenly the safety is gone, to have a European safe asset. And I have, with some colleagues of mine, we have proposed to some SB's solution where you have a European safe asset without the joint liability, which typically I think is politically infeasible to push through. And it gives still, because there's no joint liability, gives the right incentives to create a European safe asset. And instead of having these capital flows across borders, you will have it across two different types of bonds: a European junior bond and a European safe bond, which is the senior bond, the SBs. So let me sum up what I wanted to express here a little bit. So there's this diabolic loop, this doom loop, the sovereign banking nexus. You can see the tension between financial repression. That's what the governments would like to do, especially if there's a high debt level, to get rid of this debt, and the financial dominance, which is the intention by the banks to say, let's shrink our equity cushion in order not to be, losses can be pushed onto us. And that's essential. I think it's nice to distinguish the diabolic loop between default risk or the credit risk components, this mutual agreement, the weaker guy merging essentially with each other, and the liquidity risk component, which is all about short-term debt versus long-term funding arrangements. And there are interesting aspects with respect to the safe asset component, the flight to safety, and this flight to safety can, to a large extent, be a cross-border phenomenon.
Thank you. Markus already mentioned the ESRB report, and it was also mentioned this morning already. As far as I understand, and as you said before, you were not only co-chair of the expert group, but also it was mainly your initiative to do this report. So maybe just what are, from your point of view, the main results? Which are the areas where there's the most pressing need to act?
I'm so happy to be here. It means I've survived 2 years of work on this expert group, which was not actually fun, because the subject is highly political. Before I get started, let me respond to the term diabolic loop. It's not always clear to me that the word loop really captures the essence of the problem. We've had some very different experiences. In Ireland and Spain, you had a crisis from the banking system that affected the sovereign, as André explained this morning. And then the sovereign was dependent on surviving banks, essentially not the ones that had gotten into trouble, to provide funding. In Greece, we had the situation that a lot of funding had come from other countries, such as Germany and France, and of course also from Greek banks. But Greek banks stood in, and to some extent Cypriot banks stood in when funding from abroad disappeared. So that's quite a different situation from the situation that we've been describing for Ireland and Spain. Before we think about the actual analysis, let me stress that the problem of a symbiosis of a government and banks has always been with us. And in particular, the Southern European countries pre-1990 had a tradition of relying on the financial system and financial repression, banking regulation, rules for asset allocation and the like to provide for government funding. One of the findings of the report is that actually the share of own sovereigns in bank portfolios was quite low as of 2007 by historical standards. By sort of pre-1990, you'd be talking about 35 to 45% of total assets of banks. By 2007, that was 5 to 10%, even for the periphery countries. In the crisis, that went back up to order of magnitude 10 to 15%. But we're still quite far away from where the system was in 1990. Another piece of information that's important to consider here is that the entire problem of sovereign debt is related to the currency in which the debt is denominated. Sovereign debt crises in history referred to currency denominated in specie. Sovereign debt crises in the 1980s referred to debt that was denominated in dollars. We also have sovereign debt crises for debt that's denominated in domestic currency, but those tend to be resolved by inflation or even hyperinflation. So one of the issues involved is what's actually the role of monetary policy in this? Now, the euro area has a peculiar construction that currency, the currency in which national debt is denominated, is in a sense both domestic and foreign. It's domestic in the sense that it's the currency of the country, and it's foreign in the sense that the monetary authority is far away in Frankfurt and is independent. So from the Greek perspective, this was not a debt that they could pay, quote unquote, by printing money. The report documents some of the risks that are associated. I don't think I need to point out or explain how large these risks can be. Now, what's the regulatory system? The Basel rules actually do not have zero risk weights for sovereign exposures. They have a scale for risk weights according to ratings. And then there is the added passage. National authorities can go below these risk weights and have something softer for debt that central government debt that's denominated and funded in the currency of the country. The EU, in its directives in 26, made use of that to prescribe zero risk weight. So that's actually an EU rule rather than a Basel rule. There was a strong political force behind this combination of Commission and Council. A key argument: within the European Union, we don't want discrimination. And I've heard this argument lots of times in the expert group. So the expert group says, well, if you assign zero risk weight when there is risk, that's a problem. Some said, well, let's deal with the problem by eliminating the risk of sovereign debt. The majority suggested, well, maybe we should address the issue at the level of banking regulation as well. Who knows when the issue will be eliminated at the level of sovereign debt. So there are three areas that we discussed. Three main areas. First, capital regulation. From the logic of the system of risk-weighted capital regulation, it's obvious that risk weights should be applied. But we should not fool ourselves about the effects of this. The total amount of additional equity that would be needed as of the impact assessment a year and a half ago was on the order of 10 billion euros. That's peanuts. Capital regulation might have had an effect for institutions in the north, such as Dexia or Hypo Real Estate, that were very much in the business of funding governments and real estate and funding themselves by issuing covered bonds, and that had equity ratios on the order of 1%, 2%, or 3%. Dexia did not hold much Greek debt, but the haircut on Greek debt was enough to make them insolvent. Now, if there had been capital regulation for their business, they would have had more equity and could have withstood this shock. The real regulation that bites, and Claudia Buch mentioned this morning, would be large exposure regulation. With large exposure regulation, we really are talking about money. If standard large exposure regulation was imposed right now, there would be an excess of some 720 billion of sovereign bonds looking for a new home. Or the banks would have to have more equity. This is to some extent a question of transition. With sufficient transition, even 720 billion is not such an extremely large number. To a large extent, it's an issue of politics. Given the development of politics in the area, I'm wondering how much progress can be made. Of course, the ESRB, well, first of all, it did not make any explicit recommendation for any particular rule. Secondly, it's not involved in the process of legislation. If one's thinking along political lines, there is a question as to whether some of the privileges that we now assign to each individual bond, sovereign bond, should be assigned to diversified portfolios along the lines of SPs or whatever other arrangements can be designed, so that some of the funding for sovereigns that has played a key role in the European financial system for a very long time would still benefit from some privileged treatment, but only with diversification. That would, of course, enhance the emancipation of banking systems from their sovereigns, and for that reason can again be controversial. Two final comments. There are problems of consistency. First, liquidity rules have sovereign debt playing a significant role as assets needed to satisfy the liquidity coverage ratio. Secondly, for countries like the UK or Sweden, any diversification would be associated with the currency risk. So the question would be, to what extent EU legislation could be made homogeneous across member states, or would have to distinguish between these two member states and euro area members. And I'll stop there.
Thank you. Mr. Ingves, in January, the Basel Committee also initiated a review of the regulatory treatment. The question is, how high is this really on your agenda? Especially, some people are saying it's not very much a global issue, it's a European problem. And also, Martin Hellwig said went in this direction. So, is it really high on your agenda?
Well, let me try to explain a bit where we're coming from, and where we are heading. And it's always difficult when you talk about the Basel framework and sovereign risk, because some people kind of automatically react saying you shouldn't talk about it at all, and others say you should really talk about it. And being the chairman, it's hard then to figure out what to do. But I'll get to that in a minute. And of course, what we have heard earlier today in many different shapes and forms is that sovereign debt banking very often related to a banking crisis in one form or the other. But let me start with a few facts, because sometimes people claim that it's the Basel framework that makes it possible to apply a zero risk weight on sovereign exposures, and this is treated as a kind of a blanket statement, kind of assuming that that's the starting point. But that's not quite the case, because in the Basel II standardized approach, being a little bit technical here, it allows banks to apply a zero risk weight to sovereigns with external ratings AAA to AA minus, but not the rest. But as Martin Hellwig said, then at the discretion of the national supervisors, you can allow for a lower risk weight, provided, and of course then also zero, provided that we're talking about paper issued in your own currency. But when it comes to large and sophisticated banks, those who actually use models for calculating risk weights, well, models is basically about risks, and sovereign debt is not zero risk. And also, if you do the models, and we have looked into that somewhat, basically what comes out of that is that a median internal ratings model risk weight would be around 4%, which is not very high, but clearly it's higher than zero, and it produces a bit of a risk weight. So essentially the message is that when you run a bank or when you are a supervisor, from a Basel perspective, also sovereigns produce risk, and you should be mindful of that. But then, of course, one of the issues which many come back to time and time again, and the EU example is often cited, is that in a European context there is this exemption, and that has made many to believe that there is supposed to be a zero risk weight to holding government debt everywhere, all over the world, but that's not quite the case. Martin also referred to the liquidity coverage ratio and the issues there, but yes, it's true when it comes to the LCR that on the one hand Government paper is part of the LCR, but it's not the only type of asset that's in there, and one needs to be mindful of that, because you can also include corporate debt, covered bonds, a few other things. But it's also clearly stated, and again, that you should be mindful of to avoid too much concentration when it comes to different types of assets, and that's really a supervisory issue, then, not to hold government paper only just for the sake of the argument. And finally, when it comes to large exposures, the Basel Committee just recently produced a new regulatory framework for large exposures, because it just so happened that one of the first things that were agreed in the Basel Committee a long time ago was large exposures. So the old version was actually kind of old-fashioned and had to be modernized. As part of that process, sovereign exposures were not included in that conversation. But that was not because people did sort of assume that you did not have to bother about large exposures. It was taken out because, there was a need to revise the large exposure framework, generally speaking, and secondly, we were also already had started thinking about the need to deal with sovereign risk in one way or the other, and the agreement was that sovereign risk will come back one day sooner or later, and then we'll deal with the large exposure aspects of sovereign risk in that context, and that's essentially where we are presently. Also, quite recently, last fall, we started a new working group dealing with sovereign risk, and at the global level, there is an agreement that this needs to be looked into, and the review should be as the way it is expressed in terms of reference. It should be careful, holistic, and gradual. What that really means, time will tell. But for now, we are working on the issue, and it's high on the agenda in the sense that it's on the agenda, and at the global level, one has to be happy about that, because as one can imagine, there are many divergent views on this, and as history tells us, there's no such thing as zero risk, despite the fact that in many cases when we're talking about government, the risk is fairly low compared to many other undertakings, but not zero. But still, we struggle with this fact that risk is not zero, while on the other hand, sometimes it's way too easy for government to force the banks to essentially to hold too much government paper, and that usually comes back to bite you sooner or later. So the real issue is to find a reasonable balance here, accept that those risks exist, and come up with a regulatory framework in such a way that it's not too easy to circumvent it. Because if you end up with a zero risk framework, we do know from experience that will come back to bite you sooner or later.
Thank you. So you all seem to agree that there is a problem and that there is a need for changes, but then the question is, first of all, how to do it exactly, and then the question, you already referred to that, when to do it and when we can get new rules. When we start about, Martin said we have three issues here: the capital requirements, the large exposure limits, and the liquidity regulation. When we start with capital requirements and the risk weights, it was also a question posed this morning by Klaas Knut. What should be done in concrete terms? So what measure of sovereign risk should be adopted in practice?
There you already get into some of the technical difficulties. The most natural approach would be to say, let's take the Basel framework. Ratings. I'm talking about the standardized approach now. My recollection is, I mean, you mentioned the model-based approach, but my recollection is that the share of banks using the model-based approach for sovereigns is actually not very large, and most of them love the zero risk weights that they get automatically under the standardized approach and use that. So let's take the standardized approach. in good times, ratings are very good, and you don't get much of a bang from this regulation. Then, in a crisis, the ratings are reduced, and you get a very strong pro-cyclical effect. You might say, well, that's the best we can do. It's the best we do with a standardized approach in other areas. My personal view, of course, is that this is one of the many examples of why risk weighting in an attempt to calibrate is actually problematic, and why some leverage ratio floor would be desirable. In particular, since in the case of sovereigns, even if you put them into the bank book and apply the standardized approach, where even if you don't have default risk, there are things like risk from maturity transformation that are not taken into account. In a sense, we are getting into the entire mess of making sense of incoherencies in the risk weighting system. The fact that the ratings for sovereigns are unreliable and highly pro-cyclical is just one example of that.
What are your ideas? Because we have the intention to rely less on credit ratings, so we have to find some...
As Martin alluded to, these things can be done in many different ways. Bottom line is just more capital in the banks, one way or the other, when it comes to, in relation to sovereign risk that you take. And one way of doing that kind of through the back door is to impose a leverage ratio. It's not particularly designed to deal with sovereign debt, but a consequence of it is that you can't expand your balance sheet indefinitely, and we're working on a leverage ratio, and it will come. Remains to be seen what number to settle on. Another part of it is the new standardized approach that we're working on, and we're in the process of eventually having to settle on what the risk weights in the new standardized approach are supposed to look like. And we are also working on constraining the system for using risk weights in such a way that there are fewer degrees of freedom for the banks to choose the risk weights themselves. And that means that as a kind of all these things need to be coordinated, and they need to add up in such a way that the whole system with these different types of constraints actually makes sense. And part of that will actually also be then more constraints probably when it comes to holding government debt in one form or the other. That's likely to be the end result. But what it will look like, well, that's part of the global negotiation, so it's too early to tell.
And the ESRB report, at least to my knowledge, is the first such a comprehensive review of these issues. Are you using this as a kind of blueprint, or are you working on your own studies on the issue? So how does the committee wants to proceed with these issues?
Well, there is a group working on this. Very large number of people from all different parts of the world are taking this on. They started the work last fall. Too early to tell what the output will be, but their marching order, whatever that means, is to do the work in a careful, holistic, and gradual manner. So it will take a while, that's for sure.
Okay. Yeah, of course.
Echo what Martin said, in the sense that I think there's a critique that the LCR might be, the people who criticize it said, oh, that might lead to financial repression if you make it too tight. I think exposure limits don't suffer from that so much, so that this would speak more of an exposure limit and essentially giving the banks the independence from a particular sovereign, and they can spread and diversify across the sovereigns in Europe or even on a global scale. And this would actually make things much less of a diabolic loop.
And the other question then arises, whether you already touched on it, whether there's really a political will, because the recent rules encourage banks to buy sovereigns. So what's your view about potential political will. Maybe what are the results of the discussions you have with policymakers and with governments on these issues? Maybe.
Well, as we were working in this expert group, and by the way, first meeting of the expert group, one of the participants said literally, our very discussion of this issue is a source of systemic risk. We should not be dealing with this at all. I'm so happy that we haven't had a financial crisis following the publication of the report. But as work in this expert group was going on, I was very happy to see public statements by President Weidmann saying we need to deal with this problem and clean it up. And even those statements were not followed by any financial turbulence. That being said, and I mean, it's clear why the subject is on the agenda here. It's also clear why the Bundesbank sees this as an important topic. But all this being said, I have a suspicion that if we had asked Mr. Schäuble about the subject, he would have responded, or maybe not responded, that, well, this might depend on discussions between the heads of the coalition and the Savings Banks Association. Why the Savings Banks Association? Because in this country, funding of municipal deficits by the local savings banks, which are owned by the local municipalities, is a major way to avoid having to face the problem that municipal finance is in a mess. Because the federal government has been assigning lots of tasks and the regional governments have been assigning lots of tasks to the municipalities without providing suitable funding. So in that situation where the polity is dysfunctional, it's wonderful to have a bank that provides the money. And you definitely don't want to have equity requirements there because that equity would have to be provided by the very municipalities out of their budget.
Well, Martin said that, started out saying that it wasn't really a lot of fun to produce the ESRB report. But to his credit, he still decided to hang on and make sure that it eventually was published. And a lot of things actually happened as part of that process. So a more modest view would be basically to say that it's a victory in itself that eventually the report was published. And it's a thick one with lots of numbers and views on this, that, and the other. And in that sense, Martin has very efficiently contributed to making sure that this topic is on the agenda. Let me comment a little bit on the LCR, because there were a few remarks on that as well. Because, I mean, the LCR, we can argue back and forth about the LCR, whether that's the right way or the wrong way of doing it. But if you phrase it differently, saying that the only thing the LCR does is to tell banks that you have to have enough money to last you 30 days. Most people in the general public would say 30 days only. So, despite some of the technicalities that one has to struggle with it's a good thing compared to in my view, it's a good thing compared to not having an LCR at all. But there are some issues that remain there, and particularly when it comes to the way it has been designed. If you have a large banking sector, which is the case in my country, dealing with many different currencies, because then basically you need a currency-based LCR. And we happen to have one which is defined overall. It's defined in dollars and it's defined in euros. But surprise, surprise, our FSA in its wisdom have argued that there is no need for one in Swedish kroner. And being a central banker, that scares me.
And would you share Martin's argument or the view to say what really counts is the large exposure? And because we have a lot of talking about the zero risk weights, on the capital requirements, is this really the issue we should focus on, the exposure limits?
Yes.
Yeah, I know your answer Mr. Ingves?
Well, time will tell once the experts have been chewing on this for a couple of years in the Basel Committee, and we'll see what comes out of it. One needs to be mindful of, when you're doing work at the global level, that there is always a first best, but there are many different views on what the first best is supposed to be. And usually as a consequence of that, one has to accept a solution of one kind or the other, and settle for that, and see what happens. A good thing would be if there is agreement that something needs to be done. That would be a major step forward in itself, regardless of what kind of a compromise would emerge at the global level over time.
And maybe last one before I'd like to include the audience. There was a study recently by the German DZ Bank who came to the conclusion that the QE by the ECB could pose or could be a historic opportunity to change the rules, because we always talk about the problems with the demand if the rules are changed, but now there is, with the ECB, a huge seller in the market. So I just wanted to know what you think about this argument. Is it this golden opportunity now to do it?
Why a golden opportunity?
They are arguing that there now is a huge buyer in the markets. So if banks reduce their exposures, there is someone else stepping in.
In a sense, there would be an opportunity, because markets are searching for investments, investors are searching for investments, and it's unlikely that changes in rules will have that much of an effect. But changes in rules take a long time. I mean, you can't just do this by executive order tonight. In the case of rules for the banks, you have to first convince the European Commission that it should propose a change in the directive. Then the Council and the Parliament have to agree. All that takes 2 years after the European Commission has started. So it's not something which depends on current market, on the current market situation.
Just a vision. Imagine we are doing QE right now, but down the road we undoing QE. So it could be that the Portuguese banks sell all the Portuguese sovereign debt, and other countries sell their sovereign. Other banks in certain countries sell the sovereign debt. But when we go back and some of the sovereign debt is sold from the ECB back to the banks, that this is not sold at the national level, but more as a balanced portfolio. This way would get, if there are exposure limits in place at that point, it might be a ways to get to a shift in this dimension.
So maybe I just want to open the floor to the audience. Again, there are microphones, and Ami Sufi, you have a question.
Amr Sufi, Chicago. This is a question for all of you, but I guess Martin may be the most natural respondent. I've never understood risk-based weights for a kind of macroeconomic reasoning, and that is, I thought we want the financial system to help bear risk and to help share risk across the economy. And if you penalize on the asset side a bank for holding a risky asset, well, that risk is still there. Somebody in the economy has to bear risk. House prices are risky, business investment's risky, human capital's risky. And so it seems that in doing risk-based weights, on the asset side, you may help the banking system be safer, but at the end of the day, the risk is going to be borne somewhere else. And so I've just never understood, is the idea that we want the risk to be borne somewhere else? Is the idea that we think it's better borne by households or, I don't know, sovereign wealth funds somewhere else? What's the idea that motivates this, as opposed to just doing capital requirements on the liability side?
I'm the wrong person to whom to ask this question, since Anna, Matti and I recommend a very high leverage ratio. Now, we're always criticized because one can construct crazy contracts that would make the bank risky even with that. So my response to that would be, okay, if that's what we want to prohibit, have a high leverage ratio and risk-calibrated capital requirements on top of that. Other than that, I fully agree with you, and I think that some of the problems that we've had have come from biases introduced by methods of risk calibration that actually were not attuned to the actual risks, but where various artificial devices were used to hide risks without really getting rid of them.
Stefan Ingves, do you also want to share your some more questions from the audience? Is there? Did you, Andre? Did you want to? No?
Just get
Yeah, of course.
jump into Amya's question as well. I think what's the key is essentially the procyclicality, that to get a handle on the procyclicality, in my view. The danger is a little bit, I can see an argument for risk weights. If you have a common risk weights on all the risky and less risky things, what you see is that the banks move out of the less risky stuff into more risky stuff. So you see in the US actually, when the leverage ratio bites, you see actually in the fixed income, the banks are getting out of this, push it in the shadow banking system and go only with most risky aspects. So I think something one has to be aware of these things too. And of course, risk is endogenous, so it's not that it's a total amount of risk. So depending how it's regulated and how you go through the cycle, it amplifies. And to essentially what I think the whole Basel Accord tries to do is to reduce the endogenous component, because there's a fundamental exogenous risk you can't control, but the endogenous part you would like to contain. And that's ultimately what you want to have. And you don't want to push it on the taxpayers at the end of the day, their losses.
Someone else? If not, you can just think about, then well, I would jump in. To you, Mr. Ingves, we had recently a conference here in Frankfurt, and there was Commerzbank Chief Martin Blessing saying that he wonders that there are conflicting signals coming from supervisors and from central banks. On the one hand, supervisors and regulators are saying that banks should reduce their risks, rely less on leverage, etc. On the other hand, the central banks are pushing interest rates slower and lower and starting QE programs to start on. So in this way, trying to get banks to take on more risk. Isn't it a problem, really a problem for banks, that there are very conflicting signals?
I mean, this is a perennial issue when it comes to many, many problems that we deal with in society as a whole, because very often you have a short-term view and you have a long-term view, and you have to decide what matters most. And this is exactly the same issue here, because the issue is that when we're talking about setting the rules of the game, we would like to get to a point where we have very stable rules on the game in such a way that we don't run into these disasters that Andre talked about this morning, because that's very, very costly to society. But once you start working along those lines, inevitably something else is happening in the short run, where somebody will argue that this is fine and good, but not now. So in that sense, it's not that different from, let's say, fiscal issues and a whole bunch of other issues that we deal with in society, that eventually sometimes you just have to decide that regardless of where you are in the cycle, you have to get from A to B, no matter what. Of course, it's ideal if you can do it in a kind of a optimal control sense, but in the real world, you rarely have the luxury of doing things the way optimal control theory tells you to do things, because most often you're just in a corner and have to do what you have to do.
You seem to...
I fully agree with Stefan, but I think it's not just a question of how to deal with a crisis situation. I think underlying this, there is a deep dissent on, for example, what macroprudential regulation is, what macroprudential policy is about. Is it about protecting the macroeconomy from the financial sector, or is it about protecting the financial sector from macro risks? And in some situations, like when you see everything expanding dramatically, the two may amount to the same thing. But in a situation where both the economy and the financial sector are doing badly, there is a question of how you set priorities, and then there is a deeper question: to what extent are the authorities about to use the financial sector as a tool to run the macroeconomy? If you think about an instrument like targeted long-term refinancing operation, that tells a bank, you get loans from the central bank, cheap loans from the central bank, provided you use them for business loans. Who knows whether the business loans are appropriate to make? If the central, and of course there have been records of Mr. Greenspan using similar arguments in a less formal manner, but the moment you do that, you implicate the authority in the fate of the financial institutions. And if things turn out badly, the authority will be under some implicit obligation to bail them out. So I would actually suggest that we need to be very strict and very clean about the separation of these different approaches.
And we have talked a lot about regulatory treatment of sovereigns. Another issue that came into play there is the collateral rules of the central banks, because there's also preferential treatment there. Also from the ESRB's point of view, how important is it that there will also be a change there, given, for example, the ECB's collateral rules on sovereigns?
Well, I can't speak for what the ECB wants to do or not want to do when it comes to their collateral rules. Obviously, that's for them to do. Yeah. That's for them to decide.
But more general, is there a need to?
I mean, it's up to them to decide what they want to do. It's none of my. It's not my field.
Do you have an advice to the ECB regarding? No.
Well, you're raising the more general issue of what criteria to have for collateral and what operating mode to have for monetary policy. Once upon a time, I learned that monetary policy intervenes through minimum reserve requirements, open market operations, and the discount facility. Open market operations, at least in Europe, have been much reduced. And discussion about their revival is part of the discussion about what the ECB is doing, I mean, the controversy. And there has, in the meantime, been a concentration on monetary policy being carried out through lending to banks. Some of that favored by the notion that everything works through the credit channel. I'm not convinced that we really know enough about the financial system to decide whether the credit channel is the only relevant channel or even the most important channel to be looking at. But I definitely think that we need to pay more attention and obtain a better understanding of what the implications and what the risks associated with different operating modes are.
I mean, one way to see the collateral rules, I mean, in a sense, LTV ratios are also, in a sense, collateral rules. And there are two principles you might follow. So the first principle is that the central bank essentially says they want to minimize the risks they're taking on. And that's why they have these collateral rules. And whatever is more risky, they should have a higher collateral requirement. Another principle is that you want to be a more active central bank, and you want to take on some risk, or put it differently, you take some of the risk out of the economy and you redistribute it to the all nominal claim holders. That's already a much more aggressive stand, and that's the second thing. And the third thing is, I think, what Martin was alluding to as well. You might, through collateral policy, favor certain asset classes over other asset classes, which would be a very radical departure from classical monetary policy. And that's a dangerous thing. But these are essentially three ways one could think about these things. And of course, the first one is just minimizing your own risk exposure as a central bank. And then in general, a central bank is always taking on some risk. To what extent a central bank wants to assume some of this risk and redistribute it, especially if there is some impaired sectors and they're dragging down the whole economy.
Can I give, sort of transform this discussion into something more concrete? If you go back to Milton Friedman's optimum quality of money, a basic proposition is the social cost of creating money is zero, by which he didn't mean the cost of running the printing press. What he meant was that if prices are low, real money balances are high, and leaving aside transition problems, that's wonderful. So if we think about commercial banks after the crisis being given incentives, say in the US, to have deposits with the central bank, interest on such deposits. That's precisely Friedman's prescription. And you can see the social benefits associated, because if you have central bank money as a source of liquidity, that has rather fewer frictions associated to it than if you rely on the interbank market as a source of liquidity. The problem is, if you actually go on doing that, you vastly expand the balance sheet of the central bank, and you vastly expand, now in a collateral-based world, the need for collateral. And in the end, you may end up in a situation where the stupid bankers in Düsseldorf, who in Michael Lewis's account were there to purchase toxic securities from the US, might be substituted by helpless central bankers in Frankfurt. The basic issue of how large should be the central bank and what portion of risks should the central bank be taking over from the financial sector are perhaps more closely linked than they should be.
And if I may, another issue that is raised in these discussions, we already touched on it, that there is also always the possibility for governments in problems to simply inflate the debt away, so that there is a trade-off between a default risk and a inflation risk. Does that mean we need, if we're talking about changing the treatment of sovereigns, do we need to make a difference between countries like Sweden with its own currency and countries within a monetary union like the European euro area? What do you think?
Well, again, it's not for me to decide what to do within the euro area, but there are some.
But we should make a difference between
the way Martin referred to them. There are some peculiarities, but that's because it takes time to create these things in Europe. But I wouldn't go beyond that.
Yeah. Okay.
So, I mean, as Martin alluded to earlier as well, there is, of course, in the euro area, for each country, essentially, for banks, the central bank money is to some extent foreign money. Okay? Because typically, if there's a pure liquidity shock within a country, the central bank can deal with it by just, temporarily funding this problem and then taking it out again ex post. And if you have one currency, one banking system, and one country, everything can be done. Once you have the euro, which is essentially foreign, in this regard, they cannot really step in and do the same thing. The other thing is, if you think about initially when a crisis erupts, you don't really know whether it's pure liquidity problem or it is already a solvency problem. So typically it's always argued that it's a liquidity problem as a first step. Then there's this, if you go for a liquidity, for a bailout essentially through the printing press, if you go for bailout for inflation, if it turns out to be a liquidity problem, you can actually undo it later on. If you go for a debt restructuring process, then once you do the debt restructuring, you can't go back. It's like a crossing the Rubicon phenomenon. So that makes the two outcomes very different. But within a currency union, it's much more difficult to do this because this first dimension I mentioned, where essentially it's not your own currency where you're indebted in.
Just to add a nuance to this conversation, because it's one thing to talk about a banking sector which is strictly confined to your own currency area, wherever in the world we're talking about this. It's something completely different, and I use my own country as an example. When the banking sector is four times GDP, at least half of the funding comes from abroad in different currencies, because it doesn't help me to produce a ton of Swedish kronor if that's not what the banks need. So with a lot of cross-border banking, regardless of whether we're talking about this in a currency union or not, there are some nuances that just simply make these things rather difficult to deal with when things go wrong.
Do you want to add to the discussion?
I'm actually wondering, in the context of this discussion, to get back to the issue of sovereign risk. In my initial statement, I insisted on the difference between foreign currency debt and national currency debt. But that was conditioned on the notion that the government has access to the printing press. Now we have all these rules saying central banks are independent. How should we think about sovereign risk in constellations where central banks are independent? Do we say that they're not that independent? Or do we say we really need to treat this as if the sovereign risk was for real, because the central bank would, if push comes to shove, let the government default? There was a...
Okay, I thought you... Please. You said there was a question, or? Yeah, thanks.
Markus Schmidt, Deutsche Bundesbank. So far the discussion, as far as I can see, is all about how can we increase resilience enough to make sure that banks can withdraw shock. What we do not have discussed so far yet are the incentives for the sovereign debtors. And are there currently incentives for sovereign debtors to get overly indebted? And from my point of view, there are such incentives in the current environment. So probably we should put a bit more emphasis on this issue as well.
We discussed it this morning, but as well, please. Wrong incentive structure.
Well, when it comes to too much government debt coming from a country where it took us 10, 15 years to get it down to where we are today, one needs to be careful and mindful of how long it takes when things go wrong, because it's a long slog to correct mistakes that were made in the past, so one should be careful.
Yeah, I don't have a golden bullet to say how can we get rid of these high debt levels. And I guess the question was more, how can one avoid to get into more public debt arrangements? So as I mentioned earlier, we had previous historical examples where there were huge public debt to GDP ratios in certain countries. And at that time, financial repression was one way to get out of it, and I'm not recommending that, but that's essentially was possible at that time because there was a lot of financial regulation and which limited financial markets. I think in today's world, financial markets are much more open. There's much more free flow of capital across the globe. I don't think this would be possible anymore. And you know, all these measures in order to get the high public to debt ratio down, they don't sound pleasant, or there's no easy way out. But of course, I agree, there should be no incentive to build up further debt levels. Yeah, but I don't have something more to say.
I think we shouldn't overestimate individual decision making in sovereigns. Except for certain dictatorships, we typically are talking about collectivities, and the key problem that's the root cause of what we're talking about is that the different parts of this collectivity cannot agree on how to make ends meet and how to resolve the conflicts between different uses of funds. And if you have a dysfunctional polity, at some point only discipline from outside will do the job. Now, that of course is immediately related to our topic about incentives for banks. I mean, the real failure in that respect was, why didn't the financial institutions impose discipline on their sovereign debtors in the years, say, 2004, 2005, given that the rules were all such that default was a possibility? But of course, we had the same experience with the international creditors and the Latin American countries in the late 70s.
Maybe a final question from my side. When we talk about all these issues to break this close link, there's finally the question, seems to be the question, is it really realistic to break it completely? Because there are so many direct and indirect linkages between governments and banks. Is it just about minimizing the problem?
Well, if you look at various banking crises over the centuries, there are just many ways of creating a mess. So in that sense, these problems will never completely go away because it's just too tempting to one way or the other to create too much leverage somewhere in the system. And unfortunately, because that's how we operate, you discover that too late. Let me, since I have the floor, mention two other things that are kind of dealing with the same issue. Many speakers have touched on macroprudential earlier today. What macroprudential is also about, and we need to learn more about that, is the political economy of saying no. And that needs to be studied because time will tell whether people actually, those who have the right and the responsibility to say no will also do it early enough. The jury is still out when it comes to that part. Then Andres Sapir talked this morning about different countries and different ways of dealing with the banking crisis. And since my country came out kind of favorably, and I was one of those guys, the very few guys who were digging the mud, let me stress that in the darkest hours, which usually was also very late at night, we had no idea whether we would succeed or not. Eventually we did, but it wasn't possible when the work was done to fully understand whether it would work or not. We just tried to survive. And the other part of it, and the full story hasn't been told yet, which was enormously helpful, was that once the crisis reached a certain magnitude, it became very clear to the political elite that the honor of the nation was at stake. And when we got to that point, and now I'm talking about political decisions, that gave us enough guidance to go and solve the problem. It was a kind of whatever it takes moment. And from then on, we had the degrees of freedom to do whatever we needed to do to sort out the mess. And that was important.
Okay, thanks a lot. I think it was an interesting discussion. I think there's obviously a need for change, but it seems to be very difficult when it comes to concrete terms and especially on the political world. We decided to have a short coffee break now, around about 10 minutes, and then we will meet again here, let's say at 3:45. Thank you.